In this episode of Smart Humans, we do our year in review and predictions for 2026. We have special guest co-founder Vincent, Adam Katz. We talk about real estate and which markets should you be investing in and which cities are you supposed to be bullish or bearish about. It's going to be an exciting year ahead, and we cover all of that and more in this episode.
Welcome to Smart Humans with Slava Rubin, presented by Vincent. In this alt investing podcast, Slava talks to amazing minds about their investment journey and finds out what it takes to make it in the markets. And now, here's your host and smart human, Slava Rubin.
Hello, and welcome to the latest episode of Smart Humans. And today's episode, I'm excited that we'll be talking about our predictions for 2026. 2025 was pretty crazy, lots to cover, but more important is what's happening next. With me today is special guest Adam Katz, co-founder of Vincent. Welcome, Adam.
Hey, Slava. Thanks for having me.
So in the real estate world, what did you think of 2025?
I think that 2025 was pretty close to what at least I expected and what we talked about last year. We started the year, mortgage rates were in the low sevens. We got rate cuts, and now they're sort of in the low sixes, which is maybe a little lower than people thought. People might have thought more like mid sixes, but I expected it to be about this. There weren't huge surprises with the rate cuts or how mortgage rates reacted to them. Home prices are up, but they're sort of lagging inflation now, only up, a couple of percent. It's been kind of a slow rebound in a lot of sectors. But I think that for residential, it's going to continue to be very slow home growth, slow market activity. You're going to see maybe a little bump in housing sales. Right now, it's definitely a buyer's market. There's a lot of inventory out there. There's a lot of sellers, not as many buyers. As mortgage rates go down a little bit and as incomes and inflation sort of outpace housing costs, it becomes more affordable relatively. And I think that's going to bring more buyers into the market. This is, a little bit of what we expected last year. I think it's going to be more so this year. You have kind of lower demand, higher supply. The housing market has a longer lag than the other markets we talk about because it's not a liquid tradable market. So it takes longer for things to react. So right now, because supply is a little high, demand is a little low, construction, like new construction, has gone down. That's home builders reacting to that market. And so eventually, in the next year or two, that will affect supply and supply will go down again. And with mortgage rates probably going to be, half a point to a point lower this time next year, affordability is going to be better. Your dollar is going to go further. Demand's going to go up. So it's going to, it's always going back to an equilibrium. Right now, it's tilted towards buyers. By this time next year, it might be more neutral.
You mentioned rates. We kind of have stayed away from that topic in this whole discussion, which
Sure.
I think is actually hard to avoid because of how much of an impact it will have. What are your thoughts on where the rates are headed? I mean, it's kind of uncertain, especially with what Trump's going to do with a new Fed chairman. So where's your head at with where rates are headed?
I think it's very difficult to predict confidently. I think in a normal situation with a normal administration, we could probably expect a similar year, somewhere between 2 and 4 rate cuts. I know that, if Jerome Powell was in charge all of 2026, I would be confident to say we'd probably get 2 to 4 rate cuts. That being said, he's not going to be, and we don't know who is going to be, and we don't know what's going to happen there. So I think in terms of predicting it, kind of stay even. I mean, I think most likely whoever gets appointed is going to be more aggressive with the cuts. So if anything,
what do you consider the baseline? Do you consider baseline 4 cuts?
I think maybe 3.
Okay, so if the baseline is 3 cuts and you get an aggressive chairman and you get 6 cuts, what happens?
I think that definitely you're going to see mortgage rates go down and get back to a point where almost at a point, I mean, the way that this works is so many people who have mortgages have them from years and years ago, and then they have it at 3%, 4%. And so it becomes difficult to then sell that house, buy a new house at 7%, because that's just going to be a massive difference in your monthly payment. And so a lot of these people are kind of like locked into where they live. I think something like only 30% of people have mortgages over 5% right now. So it's just not, the market has kind of been stalled because of that. Uh, and specifically talking about the residential market. And so as the rates come down, if the rates get down to 5, people who are at 5 are fine selling, and then people who are at 4, it's much less of a difference. So you're going to see a lot more activity. And not just that, because it's cheaper, like cheaper borrowing costs, more people are going to be able to afford bigger houses, more expensive houses. And so you're going to get more demand, you're going to get more demand from sellers, and it's going to kind of jumpstart the market. So if you see 6 cuts, I think that the housing market's going to be a lot more active this time next year.
So for the real estate market, that'd be very bullish.
Yes.
Got it. And then what verticals inside of real estate? Which ones do you like? Which ones do you not like for 26?
Talking about commercial or just within real estate?
Just within real estate. Yeah. Which ones like commercial? Which ones do you like?
Sure.
Yeah.
Well, we haven't touched on commercial really yet, but I think for 2025, it had a very nice and slow recovery. We've definitely saw, not definitely, but it seems that we've seen the bottoming out of like the office market. That has been on the upswing, both in leasing numbers, price per square foot numbers, sales numbers. They're still well below the peak, but they're higher than they were at the bottom. And I think that's going to continue. I think you have industrial has been a pretty solid player. Its momentum slowed a little bit in 2025, but I think 2026 is going to be a good year for industrial. Retail has been pretty solid, generally pretty strong. We talked about this last year, that there'd be a slow recovery, and that's pretty much what happened with the housing market. We talked about last year that it was going to be a very slow market activity. Home price growth would stay low, a couple of percent. Rents are mostly flat. I think you're going to see a lot of that same stuff going forward. And so for me personally, I think that multifamily is going to be the play for investors this year. I personally am looking to put more money into multifamily. I think that
Multifamily is your favorite.
multifamily is my favorite. Real estate is different. We're not going to see like a massive pop in 2026, but I think now is the time to get in before things start to shift. We're still in a buyer's market. I think this time next year, we're probably going to be in a neutral market. And if rates get cut massively, maybe we're even going to be in a seller's market. So I think now is the time to get in before these kind of market dynamics change. I think that affordability is better for buyers right now. So now is the time where you can maybe get some deals. Sellers might be wanting to get out of their inventory. I think multifamily, which is, generally apartment buildings, and especially in like core metro areas, New York, Chicago, LA, San Francisco, I think
You
that's
like
my
those.
number one. That's my number one. Yeah.
So you like New York, you like Chicago, you like
I,
LA.
I always like New York, but
Nice.
I think that 5 years from now, and when you're looking at real estate, it should always be a 5-year outlook. I think 5 years from now, people are going to think like, wow, the things I could have gotten in New York in 2026, I wish I had gotten in.
That's really smart. So you like multifamily, you like industrial. So you mentioned retail and office, you like a little bit less. Is that right?
I mean, I think those are very difficult for individual investors anyway. I personally would not touch anything in those sectors. I think that they're going to be fine, but it's a much more difficult thing to project, and it's a lot riskier.
You already mentioned 4 specific cities that you like. If I put you on the spot this time next year, what are the 2 cities you like the most?
New York, and
And
I'm going to go with San Francisco. I'm biased because I'm from there, but I think that the recovery in I mean, it's a lot because of AI and AI companies, but you're seeing like the economy in the Bay Area has recovered significantly. Even like office leasing is going back up. I think demand for housing is way up. I think that San Francisco, or not just San Francisco, but the Bay Area, the San Francisco Bay Area would be number two.
It's remarkable how AI has totally changed the game for San Francisco, the town.
Yeah,
Give me two geographies that you do not like, that you're quite bearish on for 26.
sure. I mean, I think that this is pretty, this has been hammered home a lot. And so it's not like a hot take and it's not particularly original take, but Texas, Florida, a lot of the Sun Belt metros, the supply went way up. Florida has its own set of issues with the weather and insurance issues. I would stay far away from Florida,
Like the
uh,
entire state.
the entire state. And Texas, especially the major cities, Austin, things like that, Austin, Dallas, Houston, a lot of supply. A lot of people wanted to move there during the pandemic, but you haven't seen that kind of demand since then. I think that you're going to still see rents go down there. I think you're going to see prices go down. I think at some point there will be buying opportunities. I'm just not sure that this is the year for that.
That's a hot take. So you're bearish on all Florida and all Texas.
Generally, yeah.
All right, awesome.
But also in real estate.
No, I got you. Any other comments that you want to summarize for real estate for the year?
Just emphasize that I think 2026 is going to be a good year to buy. I think that this time next year, a lot of those opportunities that are here now aren't necessarily going to be there.
Awesome. Thank you, Adam. Real estate sounds like you are feeling like the floor is in. Pretty excited. It's going to be a dynamic year. We got a potential new Fed chairman. Who knows what's going to happen in terms of geopolitics. So, yeah, it's definitely, it's January here as we produce this. So it's pretty fascinating what's going to happen in the next 360 days. So thank you, Adam, for joining.
Thanks for having me, Slava.
Smart Humans with Slava Rubin is a podcast brought to you by the team at Vincent. Any data, text, or other content in this podcast is provided as general market information and not as investment advice. Past performance is not necessarily an indicator of future results. For more information on alternative investing, check out Vincent at www.withvincent.com.